script. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. If you're serious about taking your Singaporean investment journey to the next level, you'll want to hear this. Picture this. While global bond markets are struggling, Singapore government bonds just delivered a stunning 6.4% return in the first half of 2025. That's better than most stocks. Most investors think bonds are boring, low-return investments. But what if I told you Singapore bonds are quietly becoming one of the best investment opportunities right now? Today, we're breaking down why Singapore bonds are crushing it, the 3 pillars driving this rally, and exactly how you can position yourself to benefit. Let's start with the numbers that'll blow your mind. Singapore's 10-year government bonds dropped to just 2.20% yield as of June 27th. That might sound high, but here's the kicker. U.S. Treasury bonds are sitting at over 4%. That's a massive 210 basis point spread. To put this in perspective, this gap is 2.2 standard deviations below the 5-year average. In plain English, this is statistically crazy territory. But here's what makes this even more interesting for us Singaporeans. While bond prices fell globally, our SGS bonds delivered that impressive 6.4% return by outperforming 22 major developed market peers. Think of it like this. While everyone else was losing money on their bonds, Singapore bondholders were celebrating. Now, why is this happening? There are 3 main pillars supporting this rally, and understanding them will help you make smarter investment decisions. Pillar number 1 is our exceptionally controlled inflation environment. Singapore's core inflation is projected to stay within 1 to 2% for 2025. Compare that to other developed markets struggling with inflation above 3%. This gives MS incredible flexibility to keep monetary conditions supportive. It's like having a steady hand on the steering wheel while other countries are swerving all over the road. Pillar number 2 is strategic supply scarcity. Here's where Singapore gets really clever. Unlike other governments that issue bonds to fund spending, Singapore invests bond proceeds into our reserves. This means MAS can control supply based on market demand, not funding needs. Recent Treasury bill auctions show this perfectly. The 6-month T-bill yield fell to just 2% in June, with strong demand pushing bid-to-cover ratios above 2.0. For even more detailed charts, deeper dives into the data, and a full written breakdown of today's topic, make sure to check out our Substack. The link is right there in the description. Pillar number 3 is our safe haven status. Singapore maintains AAA credit ratings from all major agencies. We're one of only 6 countries globally with this distinction. When global uncertainty rises, money flows to safety. And right now, that safety is Singapore. But what does this mean for your investment strategy? Let's talk practical applications. If you're looking for conservative growth, Singapore savings bonds are your friend. The July 2025 issue offers a 10-year average return of 2.49%, starting at 2.06% in the first year. With full government backing and penalty-free early withdrawal, it's like having a safety net that pays you. For larger allocations, direct SGS investment through primary auctions gives you exposure to this trend. The recent pattern of declining auction yields suggests getting positioned sooner rather than later could be smart. Here's something many investors miss. You can optimize this within your CPF Investment Scheme. Increasing your SGS allocation in CPFIS lets you capture these returns while enjoying tax benefits. It's like getting paid twice. Now, let's address the risks because I always want to give you the full picture. Duration risk is real. If interest rates spike unexpectedly, bond prices could fall. Currency risk exists for non-SGD investors. And Singapore's bond market is smaller than major developed markets, which could create liquidity challenges during major outflows. But here's my personal take on all this. I'm genuinely excited about Singapore bonds right now. The combination of controlled inflation, strategic supply management, and safe haven demand creates a structural opportunity that could persist well into 2025 and beyond. My personal rating, This is a strong buy for conservative investors and a buy for income-focused investors. The 6.4% first half return isn't just luck. It reflects fundamental strengths that position Singapore bonds for continued outperformance. Here's my direct advice to you. First, consider maximizing your SSB holdings toward the $200,000 limit. It's government guaranteed with flexible terms. Second, if you're using CPFIS, increase your SGS allocation to capture current favorable conditions. Third, for tactical allocators, the 210 basis point spread to U.S. Treasuries has more room to run given structural factors. My unique perspective from covering Singapore's financial landscape for years. This isn't just about bonds. It's about Singapore's exceptional fiscal management creating opportunities others can't replicate. While other countries struggle with debt and inflation, we're turning our disciplined approach into investor returns. So we've broken down why Singapore bonds are delivering exceptional returns, and I've given you my personal take on how it applies to your journey here in Singapore. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. Next up, check out our deep dive on doubling your CPF retirement money. It's packed with strategies that complement today's bond discussion perfectly.